everyone, this is Eve Picker, and if you listen to this podcast series, you're going to learn how to make some change. Thanks so much for joining us on this podcast. I'm Eve Picker, and my life revolves around cities, real estate, and crowdfunding. In this podcast series, we'll be digging deep to discover how we can build better cities by building better buildings. Brian Beckon is my guest today. Brian is an attorney with over 25 years of experience working for nonprofits, startups, and publicly traded companies. Now he owns Cutting Edge Counsel, which focuses on strategies and raising capital for communities to help build a more equitable economy. If you want to know more about Brian after you've listened to this podcast, please visit evepicker.com, where you'll find links and other goodies on the show notes page, and where you can subscribe to my newsletter on all things real estate impact. So, Brian, let's talk a little bit about you. I'm just wondering how your background as an attorney led you to where you are today.
Well, first of all, thanks, Eve. This is really an honor to be on your podcast, so I really appreciate it. So let's see. It's a long journey. There were a lot of steps along the way that led me to where I am now with Cutting Edge Counsel. But I guess the short version of that is I went to law school back in the 80s with the idea, a rather vague idea, that I wanted to do something to make the world a better place. And didn't have a very clear idea of what that would mean, just that I figured studying law was the way to get there. And after law school, I did a lot of different things trying to find my way into the kind of work that would allow me to make the world a better place. And it took a few years because I landed in a law firm that was just sort of a traditional law firm. And then I was in-house counsel for a couple of different companies, one of which was a large publicly traded real estate development company called Openness Development Corporation. So I got some early background into the whole real estate world. I found myself at RSF Social Finance, a nonprofit finance organization based in San Francisco, which was really a transformative experience because that's where I came to see that there were ways of democratizing capital, democratizing finance. And that got me thinking about all the possible ways of doing things in a more impactful way, not just based on what you do with the money, but on how you raise it. And then after leaving RSF about 10 years ago, I started working on a couple of crowdfunding projects, that is to say, crowdfunding portals that were in some stage of development, and one of which, again, was a real estate crowdfunding company. So again, I kind of have, I've always had this, there's always been this sort of gravity that's brought me back around to real estate in some ways. And even though that portal didn't get off the ground, in my work now at Cutting Edge Counsel, where I've been for about 5 years, there are ways, there are things that we're exploring that you can do that are fairly innovative and really allow everybody to participate in real estate investing. So anyway, so perhaps too long an answer to your question, but hopefully that gives you some flavor for how I got here.
Well, that's kind of interesting. So I'd actually really like to hear about those things that let everyone participate. And would you want to tell us about those, the things that you're exploring?
Well, sure. So in the conventional wisdom, and if you and probably a lot of your listeners on the podcast already know a lot of this, but in the conventional wisdom, a venture that wants to raise capital needs to do so privately, and you have to go out and find angel investors, those rich folks that have a lot of money, or the institutions, or the private equity or venture capital, or whatever it is. You got to find those people with a lot of money, those deep pockets, and persuade them to invest in your project. And that's really the only option available to you. And that's the way that, that way students are taught in law school. And I assume that's the same way students are taught in business school. And that's really your only option up until you get big enough to do a full-blown IPO, until you get big enough to go public, which, in these days with the cost of going public, we're talking about, something in perhaps hundreds of millions before it makes sense to do that. So in that space between startup and going public, you're stuck raising capital privately from wealthy investors. Well, what happens if that's the paradigm that everybody follows, and that means all the good investment opportunities, because it's the folks who get in on investment before they go public, those are the really profitable investments. But in that paradigm, it's all the good opportunities are exclusively available to the folks who are already wealthy. So the wealthy can grow their money rapidly. The non-wealthy are relegated to those publicly traded stocks where the companies have already experienced their high growth, or the projects have already, they've already generated the fat returns for the wealthy investors. And then once they go public, the returns are just not that good. So you have this dichotomy where the wealthy get the good high margin, or I should say high return investment opportunities. The non-wealthy get stuck with the low return investment opportunities. And naturally, what happens? The rich get richer. The everyone else sort of can barely keep up with inflation. It's a formula that contributes to a greater wealth gap. And that's part of the problem. And, I won't go into detail about that. There's lots been written about the destabilizing effect of that. So the solution, or I should say a solution, one of the solutions to create a more equitable society is to make sure that everybody can invest. And so what we want to do is turn that paradigm upside down and say that no, everybody should be able to invest in something that's in their community, and something that's meaningful to them personally, and something that they believe in. Those good investment opportunities should not be available only to the wealthy. So then the challenge is, what are those strategies that allow you to raise what we now call community capital, true community capital, meaning from anybody in the community. And community can be a broad concept. It can mean more than just a geographic community. It can mean a community of interest, or something that pulls people together. But the point is, bringing it back around to your question, there are a number of ways that you can kind of defy the conventional wisdom and raise capital in what would be a truly public way without doing a traditional IPO. And that's where sites like Small Change come in, and other crowdfunding sites. And there are other strategies too, direct public offerings and so on, that you can use to raise capital from your community that a lot of folks don't know about. And so, these in some cases, they have been around for a long time, but haven't gotten much attention. So I think we're seeing a major shift now in sort of level of consciousness about these strategies. And Small Change is certainly a big part of that shift.
Be sure to go to evepicker.com and sign up for my free educational newsletter about impact real estate investing. You'll be among the first to hear about new projects you can invest in. That's evepicker.com. Thanks so much. Well, thank you. But I'm as excited as you are about the potential that it holds. But you said, but do you think people are really aware of these opportunities yet? I feel like investor education is really not there. That is a very small segment of the world that understands that they can invest in this way and even know about what is happening.
Yeah, you're right. Because what we're trying to do really is change the culture in a profound way. And yes, education is key, and education in a very broad and deep way. I mean, consider that most people do not think of themselves as investors. For decades, people have been told that if you're not wealthy, you're not qualified to invest. And so people just don't even see themselves as investors. we see ourselves as consumers. We see ourselves as workers. Workers and consumers basically feed the machine. So we're feeding the machine. That machine is designed by and for investors. And we, most of us don't think we're qualified to get in on the game. And so there's really a cultural shift that we need to make. That's, it's kind of thinking broadly, it's about empowerment, to empower everybody to feel like they can be a full participant in the economy, be fully engaged in what's going on as investors. But it's such a profound cultural shift. We've got a long ways to go. So even though all the legal tools are there, they're very underutilized. And you're right. So not many people, regular folks who aren't part of this, this sort of sector we're in, regular folks just don't know about these. They may have heard about crowdfunding, but they may be a little skeptical. They may have heard that that's really risky, and it is, and that is an issue. But the point is, they generally, they don't know what their options are, and if they have heard of some things, they are perhaps, I wouldn't say the word scared away, but aren't enthusiastic enough about it. Haven't really gotten to like engaged in it. Yeah.
I think they are scared away. I mean, I go to some of these crowdfunding platforms. I'm a pretty experienced developer and an investor, and yet I find myself going to some platforms and looking at the presentations and feeling a little scared because they present towards a very, very sophisticated investor who understands a special lingo that's only for them, right? So I think it's absolutely scary. And that's perhaps, you might know, but people listening to this probably don't, that one of the securities rules that came out of the Jobs Act, regulation crowdfunding, which really permits everyone to invest. One of the things I like about that rule is that it requires everything about the offering to be in plain English. And I think that was a pretty meaningful thing for the SEC to add, because, when people like myself are scared at, trying to unravel an offering, well, imagine someone who's never done anything like it before.
Yeah, you're right. And frankly, at the risk of sounding perhaps too skeptical, frankly, I've seen a lot of bad deals out there on some crowdfunding sites. And by bad deals, I mean, it's not that they're, I've seen deals where a company is raising money with an assumed valuation that's just astronomical, $30 million. And if you really dig into it, they don't hardly have anything. They have some good ideas, but the company probably isn't worth more than $1 million, maybe even less. And so when people invest at a $30 million valuation, they're getting buying stock that's grossly overvalued, or perhaps a reverse way of saying that, they're not going to get as much back as they think they're going to get. And I see a lot of these deals, and they do make me nervous. And I do worry that there are going to be a lot of losses, and that makes me nervous. And that's actually one solid reason why, for those investors who don't have a lot of sophistication in picking good investments, real estate still remains a pretty solid, I should say, relatively safe way to invest, because, you're not going to lose as much. You're probably not going to lose as much money on a real estate investment as you would in a startup company that values itself at $30 million.
Yeah, I think that's right. That's right. You can at least, hop onto Zillow and check out the comps yourself and really kind of snoop around a little bit in an everyday manner and feel comfortable with what you're investing in. I agree. I personally feel less threatened by investing in real estate than in companies I don't really understand. So, but that's like equity investing at large. I mean, how it becomes even a little more difficult when we bring impact and social responsibility into it, doesn't it? And I'm just wondering, I suppose, how you feel about, like, What, I don't even know how to say this. What level of, additional difficulty does that add to a real estate deal? Like, what sort of things are you seeing in community capital raising that kind of makes it different than going to a crowdfunding platform that lets you invest in, a very traditional Walmart or Target or something like that?
Yeah. Well, okay. So good question. And it raises this whole question about, what does it mean to make impact? And, that's, much has been said and written. We're not going to solve that, that right now, perhaps. But let me just sort of give you my take on this question of impact. And starting with the premise that we all want to, invest our money in a way that, again, is in some sense making the world a better place. So how do we do that? I kind of see impact as happening in two, broadly speaking, and this is an overgeneralization, but broadly two ways of making impact. One is by making sure that your money is doing something good in the world, whatever that may be, housing the poor, building a hospital or a school or something like that. The money is being used in a beneficial way. But there's another way of making impact that isn't often discussed, and that is really by focusing on the process. If you're raising money for an impactful project, and only the very wealthy can invest in it, and let's assume that it's a profitable project, and these wealthy people invest and they make 10% return on their investment, and they're richer and happier. And yes, the project does some, has some, some positive impact. Does some good. And you're whatever it is, you're building, you're building some housing or something. That's one kind of impact. But I have to admit, I'm a little skeptical of what often passes for impact, because I think a lot of impact investing, frankly, does more harm than good. Why? Because you're still concentrating wealth. And as long as you're concentrating wealth in the hands of the wealthy, how impactful can you be? Yeah, you're building a hospital or a housing or whatever it may be, but ultimately it's really the wealthy investor who wins. And when an investor is making high returns, you can make the argument, and maybe I won't push that point too far, but you could make the argument that anyone making high returns is extracting wealth from the system. I mean, you're leaving someone else less well off because you're making high returns. So I guess, that brings me to the other way of having impact, which is via the process. And if you're raising money for a profitable project, and whatever it may be, and I would argue it almost doesn't matter what you're actually doing with the money, but if it's a profitable project and you're raising it in a truly democratic way so that everybody of any wealth can participate fully, now you're not concentrating wealth in the hands of the wealthy. Now you're actually sharing the wealth in an equitable and fair way. That process itself is impactful, because now you're creating wealth building opportunities for those that otherwise would not have had wealth building opportunities. And this can help to shrink the wealth gap. And along the way, when regular folks who haven't had an opportunity to invest in impactful projects now do, that can contribute to a greater sense of empowerment and lower community engagement. And you can follow out the chain of causation there. I think that has broad implications beyond just profits going into their pockets. So I really see that the process of community capital, as I like to call it, this idea that you're opening up an opportunity for anybody to invest regardless of their economic status, that process is itself more impactful than just about anything you can do with the money, if you see what I'm saying. It's about the process.
I do. That's a really interesting thought. But, in real estate, there are still so many hindrances with regards to that process that most people don't think about. I'll give you just a couple of examples that maybe I'm sure you have more, but one is in talking to one developer about presenting a side-by-side offering, which is using two securities rules, one in which anyone can invest and the other which permits accredited investors to invest with large amounts. That developer suggested that the accredited investors get a higher return. And I was a little shocked by that. I'm thinking, just because you haven't reached the accredited bar, why does that make your money less valuable to the developer? I don't understand the thinking behind that. And yet I think that thinking is pretty prevalent just in the way you described.
Yes, I have seen that same phenomenon, and I find it very disturbing. All things being equal, the same degree of risk, but we're going to give greater reward to the wealthy than we give the non-wealthy. Somehow we think they deserve it because they have more money, or maybe they simply demand it because they have more leverage. Whatever the reason is, it's fundamentally inequitable, and I think we need to resist that.
And further, for someone who has less money, it's an even bigger risk. So it's even more inequitable if you want to think of it that way.
Right.
I find that very disturbing. But then there are other issues that pop up in real estate. For example, banks always want to have a 20% partner or shareholder or member of a real estate project guarantee the project. And so in one crowdfunding offering that we did, the investors actually held 90% ownership. And that really confused the bank. The 90% ownership was a whole crowd of investors. So they really didn't know what to do with it. So there are some structural problems in the way that we finance things that a crowdfunding is kind of bashing up against. Another example is the new market tax credit world, where I have seen time and time again really convoluted financial structures so that those big investors don't have to invest side by side with the little ones. And that's exactly the way they talk about it. So I think we're pretty far off from from really sort of getting to the end goal, which is that the money that comes through crowdfunding or community capital raising is treated in exactly the same way as everyone else's money.
Yeah, I think you're right, that we are a ways off from that. And, I think there are some things that we can do to get closer to that goal that of a truly level playing field where it doesn't matter how much money you have, you should be able to get the same return on investment. And I think one of those strategies that we can use to get toward that goal is to use, what we might call community investment funds, where, because part of the problem is the small investors who can put $1,000 or $2,000 into a project really probably don't have the bandwidth to do the kind of due diligence on individual projects that someone putting in large amounts would do on the project. And so you do have that, imbalance of information. When you have investors who aren't doing the due diligence, they're more likely to make, the wrong choice than those who have more time and resources to put into the diligence. And I think the way to get around that is to set up an intermediary fund that can do the due diligence, but aggregates capital from many, many investors, and then is careful to do the kind of due diligence on every investor, on every investment that anyone with deeper pockets might do. So I'm a big fan of community investment funds in general. And real estate, again, is one of those areas where, where a community investment fund can be particularly impactful, but there are a variety of different kinds of community investment funds that can be built.
Okay, well, I'm going to shift the conversation a bit to real estate. And I'm wondering whether you think socially responsible real estate is necessary in today's development landscape. And if you do, why?
Well, yes, I do. And so we can talk about what what constitutes socially responsible real estate. But yes, I mean, you definitely can see where projects are rather extractive and are designed to maximize profits for investors versus projects that are really designed to serve communities. And we don't need the former, we do need the latter. And so I do think that's an important distinction. And, for example, I live in the city of Concord here in California, and there are projects being proposed to build all these what are euphemistically referred to as market rate housing projects. These what really are top dollar, more luxury apartment complexes. And does the city need those? No, we don't need those. But that's what developers want to build because they know that there are high profit margins, and that's what investors want to invest in, even though that's not what the city needs. What the city needs is more moderate income housing, but that's not as profitable, and no one's interested in building that except for one or two nonprofit developers. So we do have the problem that the wrong kind of development is going into, particularly lower income communities that cause gentrification. And what we need is more community driven real estate where the communities can say, here's what we want, here's what meets our needs. And so I think this probably fits into that category of socially responsible investment, perhaps among other things.
Right. So, have you noticed any trends or projects out there that you think can solve those sorts of problems?
Well, yeah. So I mean, let's take opportunity funds, for example. Opportunity funds, as a lot of folks know by now, because it's been in the news a lot in the last year or two, are a type of fund created to encourage investment into low-income communities, and that encouragement comes in the form of a tax break for investors. And the conventional wisdom, and as you probably can tell, I tend to be cynical about conventional wisdom, but I'm gonna
join you on that.
But the conventional wisdom says that only wealthy investors can get those tax benefits because they have to do with rolled over capital gains, and who has all the rolled over capital gains? Well, it's the wealthy. So these opportunity funds are basically almost always set up for wealthy to invest, and as just as I suggested a moment ago, when it's the wealthy who are investing in real estate in low-income communities, what do they want to do? They want to build, high-end housing. Which does that serve the community's needs? No, it doesn't. It drives out the local residents. It forces them to move to some other more affordable community. It increases the prices. In fact, since the Opportunity Fund law came into existence about a year and a half ago, some studies have shown that housing costs in opportunity zones have risen 20% compared to comparable low-income communities that were not designated as opportunity zones. So you have a 20% increase in prices just because it was designated as an opportunity zone, which means that gentrification is happening in these communities because of this, investment, or at least potential for investment by again, typically wealthy people seeking to, reduce their taxes. So that's the problem, but that's not really what you're asking. You're asking, what's the solution? And the solution is to take this idea and make it a true community investment fund. And so, contrary to the conventional wisdom, anybody, including non-wealthy folks, can get tax benefits from investing in an opportunity fund. And when you have an opportunity fund that is open for investment by the community and reflects the voices of the community, so one that's somewhat democratically governed, now you have a very different kind of thing. Now you have a true community-driven investment fund where they're going to build the kind of housing, if it's a housing fund or whatever it may be, they're going to do the kind of projects or developments or housing that the community wants and needs. And when it is profitable, those profits will circulate within the community. If that's where your investors are, that's where your profits are going. And that's an important point that people sometimes forget. And again, to restate it, wherever your investment comes from, that's where your profits are going. If you want capital to stay in the community, you've got to raise capital from the community.
Right.
So that's the way to solve that problem, I think.
Yeah, it is. But, often these communities, the communities you're talking about and that we're interested in are slightly depressed, and they certainly don't have strong market values, and and perhaps the people in them, it's difficult to raise enough capital to do large and meaningful projects. And it's difficult to even finance projects because banks don't see the value in those communities either. So you're left with these yawning financing gaps that you have to fill in a number of ways. And actually, it becomes very difficult to project any return for investors. So while I agree that communities should benefit from improvements in their own communities, it's very tricky finding a community that can really happen in, I think.
Yeah, no, you're absolutely right. So I don't want to minimize the challenge it is to raise significant amounts of money from a lower income community. So let me say a couple of things there. One, almost every community has resources, even if it's a lower income community. If the data shows that 50% of a community is below the poverty line, well, then that means 50% isn't. And so there is money in every community, even low income communities. But that brings us back to the sort of the cultural challenge that we started about earlier, which is that the folks in that community who do have some money, and we're not talking about millionaires, but we're talking about people who have some money to invest. They may have, they may be able to write not a $50,000 check, but they might be able to write a $1,000 or a $5,000 check. But yet those people will tend to just put their money in Wall Street because that's all they know. So it brings us back to this cultural challenge, this educational challenge that if you want to raise money from within a lower income community, you've really got to do some outreach and to talk to people about the fact that it is possible, that they are qualified, that they can invest in their local community. They don't have to, send their money to Wall Street. So it is a challenge, but it can be done. And we've seen examples of where it has been done. And this, while not exactly a real estate project, I think it's relevant. We have a client at our firm called Community Foods Market, which is building a grocery store in West Oakland, a low-income, disinvested part of Oakland, California. And they specifically wanted to raise capital from the community. And we helped them do that through a direct public offering. And so the outcome was, yes, they did raise about $2.2 million in this direct public offering. Now, that's just part of the capital stack. It talks more than that to build a grocery store. But the point here is that they raised capital from I think they have about 500 investors. Most of them are, in fact, residents of this low-income community. Most of them in terms of number of investors. Now, to be sure, the biggest dollars came from the wealthier investors, and many of those, probably most of those wealthier investors and institutions worked inside that community. So it is true. You still probably need to raise some of your money, if not most of it, from outside the community. But the important thing is that by specifically focusing the capital raising campaign on the community, that had a lot of benefits. The community is invested. The community is engaged in the project. They're excited about the project. And when there are profits, at least a portion of those projects will go back to the residents of that community, which is exactly what he wanted to do.
So, then I have to be a little bit mercenary, because one of my frustrations with what we're trying to do is the return that most people want. And I'm not yet convinced that they'll take a lesser return for impactful real estate. So the question is that community, does that project compete for return with many of the real estate projects we're seeing on crowdfunding platforms, which boast, 20 to 25% internal rate of return? Or is that community project likely to return something lesser, but the people in that community get some other less tangible return having a supermarket in their community, for example.
Yeah. So, right. I mean, you do have that challenge, and all things being equal, if I'm looking at two opportunities and neither of them is in my community, and one is, promises a 5% return and the other promises a 10% return, I am more likely to invest in the one that offers a 10% return. Now, if you tell me that the 5% return project is going to be more beneficial to the community, that may affect my decision, and maybe I'll go with the 5%, because after all, that's still better than I can get on a CD, bank CD. It's still better than the stock market is doing. It's still 5% is still a good return on investment.
Mm-hmm.
But now if you change that hypothetical and say that 5% project is in my community and actually can benefit my community and contribute to local tax base, and the owners are, have kids in the same schools that my kids go to, and they're going to, contribute to, some of their profits to local causes. Well, that makes it a very different scenario, because just as I'll, donate my time and sometimes donate my money to local things in my own community, why wouldn't I invest locally at 5% investment instead of 10%? If you have all these other things that happen that benefit my own community, that make my life in some way better. But I think that's part of the power of true community investing. If you can reach someone, really their backyard, these are people that want projects in their backyard to succeed. And so I think that can help you raise capital for projects that maybe don't promise the highest return. But, I also acknowledge that, to some degree, this is theoretical, because we haven't seen enough of these kinds of deals perhaps to be able to say with, real evidence that people will invest for a lower rate of return as long as it's in their community. I have not seen specific evidence of that. And, intuitively, I believe that's the case. But have you seen that in your work?
No, not yet. No, maybe a little bit. We've certainly seen on some projects that more people locally have invested, but I think, I'm sort of interested in understanding what community engagement tools you think work, because I think we have to get better at it. It's difficult finding people in communities. And, often real estate developers, this is not what they do. They don't market in that way. They put a deal together and build a building. And now you're telling them, well, you got to go reach out to all these people in the community. And that's not part of their wheelhouse, right? So I think community engagement and finding the right tools is probably a big part of this. Do you agree?
Yeah, I totally do. And, for years, we have been helping organizations with various strategies of community capital, and now with the Jobs Act, regulation, crowdfunding, that opened up a whole new avenue for ways of raising capital from a broad cross-section of one's community. But even before that law came into being, direct public offerings have always been out there. So we've been doing this for a number of years, and we have consistently found that the key differentiator between those that succeed in raising the capital and those that don't succeed in raising the capital they need really boils down to marketing. It becomes a marketing campaign when you're doing something that involves a public offering. And I think, even crowdfunding portals, and I assume this is probably true of small change, you can't just, it's not one of those build it and they will come kind of things. You still have to market the offering. And the project manager or promoter, they still need to pound the pavement and get the word out to their network, and they need to reach out to their community, and really it takes some effort. And so having seen some of these over the years, seeing some of these offerings not succeed, we definitely nowadays almost always recommend to our clients that they get good marketing help. And that may mean actually hiring a marketing and communications firm of professionals that can help in a number of ways. I mean, fundamentally, they do several things. One, they help you refine your message and help you, tell your story in a compelling way. And then 2, they can help you figure out who is your ideal audience, whether that is in your geographic community or other communities of interest that may be more dispersed. And then 3, how do you find them? How do you, put the message up where they're reading or where they are? And a marketing firm can be really invaluable for that. And I would say, again, of the folks that we've helped with, community capital offerings that have not succeeded, almost always it's because of a lack of marketing. So
yeah,
I think that is really important.
Yeah, I completely agree with you. So this has been really interesting, but I've got 3 sign-up questions I want to ask you. And okay. The first one is, what's the key factor that makes a real estate project impactful to you?
Well, I mean, number one, as I kind of suggested earlier, is I want to see something that is offered openly on a level playing field. I want to make sure that it doesn't serve to concentrate wealth by being only available to the wealthy. So I like to see projects that are open to the crowd. 2, it's got to be non-extractive. It's got to serve the community. And so, as someone from outside a community, let's say the project is in some town that I don't know very well, I may not have a good sense of what that community needs, but hopefully, it'll be clear in the disclosure materials, what kind of community it is, and we'll be able to make some assessment of whether this sounds like it's actually meeting the needs of the community, or is it just an opportunistic way to extract more profits from the community? Because we don't want to, I don't want to invest in anything that's extractive. Really want to invest in something that meets the needs. Okay. Yeah, I don't know. Does that help?
Yep, it does. And then, so I think we know the answer to this too, but I'm going to ask you again. Other than by raising money, in what ways can involving investors through crowdfunding benefit the impact real estate developer?
Well, yeah. So one thing about raising capital from your community is, from a broad number of people, is you now have a lot of people who are invested in you. And that means that has a number of implications. They're going to be on your side. They want you to succeed now because they're financially invested in your success. And so that really helps to build community engagement, which can be really valuable if you have projects that, say, need local, local government approval or what have you, or if it's a sort of a project that is going to be a customer facing project. Let's say someone. Someone, I don't know, use a non-real estate example, and there probably are some good real estate examples too, but one sort of obvious non-real estate example is someone, builds a brewery and they raise capital from a community of people. And now what happens? Those investors in the brewery, if they want to find a beer, where are they going to go? They're going to go to the brewery where they're a co-owner. Of course they will. And that's where they're going to send their friends. And so your investors can be your best customers. They can also be your best ambassadors. And I think that also can translate into the real estate world too. It just helps having dozens or perhaps even hundreds of advocates in a community that can help you be successful.
That's a great answer. So, and then finally, this is a really big one. How do you think we can improve real estate development in the United States so that it's better for everyone? Cities.
Well, yeah. I think we need to have real estate development more community driven. Right now, I think the big problem is real estate development is almost always driven. That is, the agenda for real estate development is almost always driven by the wealthy investors. And what do wealthy investors want? They want to increase their wealth at the highest rate possible. So most real estate development is not done with a view to what the community needs. It's done with a view to how can profits be most efficiently extracted out of a community and placed into the hands of the investor. So I really think the number one thing that we need is to change that paradigm and have real estate investment done in a more community-driven way. And the only way to do that, frankly, is the things we've been talking about by having the community, the investors, by building real estate funds that are community-driven. And then we could talk about, governance of a fund, and if a fund actually actually reflects the voices of the community that it's serving, then it will, probably do the things that the community needs, not the things that some rich investor somewhere else wants. Right. And so I think that's maybe the biggest paradigm shift that we need in order to achieve a more equitable and fair and resilient society.
Well, thank you very much, Brian. Thank you for having this conversation with me. And we're signing off now, but I hope everyone listened all the way to the end.
Well, thank you very much, Eve. It's been a real pleasure chatting with you.
That was Brian Beckon. I hope you enjoyed listening to him as much as I enjoyed talking to him. Brian gave me 3 great takeaways. First, that we need to share the wealth. Second, that it's possible to fund projects through communities, not just private equity. And third, that everyone deserves to invest and get a return. What did you learn? You can read more about Brian on the show notes page for this podcast at evepicker.com. While you're there, please consider signing up for my newsletter to find out more about how to make money in real estate while making some change. Thank you so much for spending your time with Brian and I today. We'll talk again soon, but for now, this is Eve Picker signing off to go make some change.